The Federal Reserve has just paused the interest rate hike in June 2023, and I think it's time to look at some Singapore REITs. Hi, I'm Alvin and CEO of Dr. Wealth, and in this video, I'll share with you 3 REITs ideas which I think are worth considering. So watch until the end of the video and I'll review the answers to you. Today's episode is brought to you by FinBite Insights. So this FinBite Insight is started by Alvin, and that's me. And each day I will articulate my thoughts about the financial markets. Just by reading it in less than 3 minutes, you will be able to get a very good understanding about what's going on, what's the most important thing that you need to know about the financial markets for that day, and how do you interpret it so that you can make better investment decision out of it. So do remember to go to finbiteinsights.substack.com and you can subscribe it for free. Start enjoying the daily insights that I'll deliver it to your inbox. So the usual disclaimer, I'll be talking about specific stocks and REITs, so do not take this as financial advice. I'm not a financial advisor, so just treat them as some trade ideas for you to consider. Please do your own due diligence and you're responsible for your own investment results. So now let's go back to the Federal Reserve latest announcement, and what they have mentioned is that they're going to pause the interest rate hike in June 2023, and they did signal that future rate hikes are still possible. And based on the votes done by the Federal Reserve Committee, which is based on the dot plot, okay, that was been published, and what they were saying is that they are expecting the interest rate to go up to about 5.5% until the end of 2023. So we are now at 5 to 5.25%. So which means there is room for a further rate hike of about 0.25% or even stretch until 0.5%. So this can be happening in July or November in the next few FOMC meeting. So that is the latest changes to the interest rate hike situation. Next, let's look at what the futures market is saying. So the market is expecting that this rate hike is going to happen, and it's going to be just a 0.25% hike once in July, okay, starting in July, and they will reach that range of about 5.25% to 5.5%. So that is the expected peak interest rate as of now, and that means that we are not very far off from the peak interest rate, and that should give stability to the market. So if interest rate is near the peak, it also means that some of these stocks that have been punished by interest rate would have been close to the bottom. That's why I think it's time to look at some of these investments. Of course, some investors do have another concern, which is related to the debt ceiling. Although Biden has already signed the suspension of the debt ceiling until 2025, there is another thing that we should be aware of, and that is because once the ceiling has been suspended, that means US can continue to borrow more money. How does the government borrow more money? They issue bonds. Okay, they issue treasuries, and it is expected in the next few months a huge amount of treasury worth $1 trillion is going to flood the market. So when the treasury supply increases, the prices of this treasury will fall, right, because of supply and demand dynamics. And the bond price with the interest rate are in inverse relationship, so which means that when this treasury prices goes down, the interest rate will get pushed up. So that is the concern that I'm talking about. There might be some upward pressure on interest rate when these bonds are being released to the market. But then again, my view is that it might not be as bad as what people think it is, because in the past 10 over years, the Federal Reserve have been printing a lot of money, right? There was QE 1, 2, 3, 4, okay? And right now, the Federal Reserve assets have been ballooned to $8 trillion. So there are a lot of liquidity that's flowing in the market even as of now. So if let's say the government take back that $1 trillion by issuing the bonds, I don't think it would be a very big impact to the market. There's some liquidity being stocked away, but I think there is still too much liquidity that the market definitely can afford to lose some of it. So which means that I think the interest rate would be rather stable, right? Even if they hike one more time by 0.25%, we would be able to have a lot more visibility and more stability going from here. And that's what investors like, because investors initially last year didn't know where the interest rate will go, when will we end, but now it is clear we are very close to the peak interest rate. And that is why I do think that it is time to look at some of the REITs in Singapore, because in the past 1-2 years we can see that the REITs have not been really performing. This is the chart for the IHS REIT Leaders Index, and this is the 5-year chart. So you can see that it was a big drop in 2020 due to COVID, and then you have a very sharp rebound. And then after that, it was like stagnant for about 1+ years. Then in 2022, when the rate hikes came in aggressively, the S-REITs prices just fell. And it fell to the COVID low in 2022. And then it had a bit of rebound at the start of 2023, but now it is down back again. So it is close to the 5-year low or the COVID low that we are looking at. So which means that there are opportunities for us to look at some of these REITs. If you miss the COVID low, if you miss the last year low, now is the third chance. So don't miss it again. So I think the interest rate and the inflation risk have largely dissipated. Okay, it's not like it's totally gone away, but it is not as serious as what people think it is. And commodity prices have been falling too. And which means that the reason for the Federal Reserve to hike more interest rate is getting lesser and lesser, and that's why I think that this S-REIT now, after being beaten down so much and yet to recover, can present investors a chance to still buy at a low price. And of course, we don't know whether this is really the bottom, right? So let's say, touch wood, if the prices go down further, investors can also be more prudent and conservative in the sense that you don't go in with all your capital at once. You can dollar cost average. If the prices go lower, you can buy more at lower prices. So it does take some discipline, it does take some patience, and it takes some courage to go against the grain, because right now REITs investment is not as hot as before, okay, because of the lackluster performance in the past few years and because of the interest rate environment. But that is where trouble means that prices are cheap, and that's where investors can find some gems at a great bargain. I'll share with you 3 REITs that I think are worth considering. The very first one is Keppel DC REIT, and this is of course a data center REIT, which is a specialty REIT. Not every building can become a data center. It does need some special knowledge in order to manage this set of properties. And the good thing that I like about Keppel DC REIT is that majority of the properties are located in Singapore, and we know that Singapore is a very land scarce area. We can't afford to build a lot of data centers like what other countries do, and yet Singapore is a key connectivity hub in Asia Pacific. So that real estate, if you have a data center here, is very, very precious. And in the past few years, in fact, if you want to open a new data center, you build one, new one is not allowed. Right now it's okay, right? But it's still not easy to get it approved to build new data centers because they are energy guzzler, they take up space, and we have other land demands such as residential, commercial, industrial. So I do think that Keppel DC is in a good situation, right? It owns quite a large number of data centers located in Singapore. So that itself is a competitive advantage. If we look at occupancy, it's very high at 98.5%, close to 100%, and they have a long lease, average about 8.2 years. So you will be able to see the stability in its rental income. And in the first quarter results, Keppel DC REIT managed to pull off growth, right? Because in this period, it is not easy to grow, especially there is an economic slowdown, not just in Singapore, but globally. And yet, Keppel DC managed to raise the distribution income, raise the distribution per unit, and I think this is highly commendable. And this is what we really want to see, right? In the worst of times, and yet they are able to increase value, able to grow the company. And the track record has been good in terms of returns as well. Listed about 9+ years ago, total return is 215.98%. Okay, that is inclusive of dividends and capital gains, and which average out to an annual gain of about 14% per year. So that is quite an impressive return, I would say, for a REIT. And not only that you receive consistent dividends, but you also can see that this has a distribution per unit growth, which means that your dividend grow over time. Even if you do not add in more money into the stock, you get more dividends next year, next year. Okay, so more importantly, we can also see that in 2020 and 2021, they didn't slash the dividends at all during the COVID lockdown period, right? Because data doesn't need to be isolated, doesn't need to be swapped. Okay, so they do have that resilience, and going forward, it's not difficult for investors to understand that internet connectivity is so important. It's almost like a necessity. It's not even a luxury anymore. It's a need, it's not a want. And that means that data center will continue to play a very important role in our new economy. And now let's talk about the valuation, right? So I always like to look at the 5 years ranging, and for REITs, ultimately is the underlying properties that are valuable, and that's where the price to book value makes sense, right? Because the book value is the equity value of the properties that the REIT owns. So I'll look at the 5-year price to book ratio. So this is taken from the Tiger Brokers, and you can see that there are some lines, horizontal dotted lines, right, around that blue line. Okay, so the blue line, the jagged line, is the price to book ratio. It's not the price, okay, it's the price to book ratio. And what we want to see here is that when the price to book ratio is at the -1 standard deviation, that gives us the sense that the price is low, right? It's at a relatively 5-year low mark. So conversely, if it's at +1 standard deviation, it tells us that it's overvalued. And if it's at the average, means that it's probably fairly priced. So now at this moment, you can see that this Keppel DC REIT is at -1 standard deviation, and that's why I do think that the share price have probably priced in the rate hike since last year, and it is still a good opportunity for investors to look at this stock. So the second one will be Mapletree Industrial Trust. It is a blue chip, it is a STI component stock, and it also have data centers, right? More than half of its property portfolio has data centers, and the other 40-ish% is in industrial properties in Singapore. So this is more diverse than Keppel DC REIT. Okay, so they don't just have data center, and so if investors who want more diversification, this can be a consideration over Keppel DC. Another thing about this Mapletree Industrial Trust is that recently there was a bankrupt case in one of the tenants, and happened to be the third largest tenant for Mapletree Industrial Trust. Even though it sounds like it is a big tenant, but it only contributes about 3.2% to the rental revenue for Mapletree Industrial Trust. So it is not that bad even if it totally get wiped out. And that is because Mapletree Industrial Trust have to over 2,000 tenants, and this is probably one key thing that investors can learn from this episode. You do want to see that a REIT has many tenants rather than over relying on one very big tenant. Okay, if it's a one very big tenant, I would think that it probably need to be like a big company, right, such that the chances of it going bust is very low, right? Or even maybe the government agencies. Okay, so in those cases, I think you can make certain exception. But if, let's say, especially the credit rating is not very good, yet they have like a very significant exposure to the tenant, I think that's where the risk is going to come from. So for Mapletree Industrial Trust, there isn't this big risk that we are talking about due to the diversification of its tenant base. Similarly, Mapletree Industrial Trust have done very well in the past 10 years, delivering 200% and an annual return of about 12% per year. So again, this is total return inclusive of both dividends and capital gains. Dividend growth, we can see here as well, a very good track record over the last 10 years. In 2023, there was a slight dip in its distribution per unit. I think it's also because 2022 they gave a lot more dividend as compared to the past. So I think actually it's still in line with the dividend growth trajectory if you assume that 2022 DPU is between 2021 and 2023, right? So if you can see that it is still like a staircase-like pattern, and I don't think that they have any big issues, because in terms of occupancy, in terms of revenue, they are still largely on track. And again, this is the price to book chart, right? And maybe let me blow it up for you so that you can see it clearer. And that's the 5-year range. You have the -1 standard deviation, and currently the price to book is also below that -1 standard deviation for Mapletree Industrial Trust. And forgot to mention is that this REIT also have a slightly higher dividend yield, about 6%, as compared to Keppel DC REIT, which is about 5%. So usually data centers have a premium on its share price due to the higher value properties, right? So for Mapletree Industrial, because it has half in industrial properties, and that's why that yield is higher to compensate for the perceived relatively lower quality properties as compared to the data centers. So the third one is Mapletree Logistic Trust. This is also a STI component stock, and it's not difficult to understand, right? Warehouses, and increasingly because of e-commerce, cross-border transportation to deliver your stuff to you from another country, all these warehouses are very crucial and critical for the new economy as well. And looking at their geography, right, unlike what we saw just now in Keppel DC and Mapletree Industrial Trust, which they were mainly in a few countries, right? Like for example, for Mapletree Industrial, they were mainly in Singapore or US. But this Mapletree Logistic Trust, they have properties in many countries and largely in Asia Pacific, Okay, so they are definitely a lot more diversified, and that reduces the geographical risk. And on top of that, I do think that for logistics, it's important to have multiple locations in different countries. Then you will create a network effect. Because you think about it, let's say you're an e-commerce player and you rent warehouses, right? And you're going to ship your stuff all around the world. And if you can go to Mapletree Logistic Trust and say that, okay, I need this warehouse, one warehouse in Vietnam, one warehouse in Indonesia, one warehouse in Singapore, and you can just deal with one landlord. Mapletree Logistic Trust can handle all this for you. So if let's say you only have a warehouse in one country, there isn't a network effect that you're talking about. The tenant may not be able to rent everything from you. They still need to look for other landlords in other countries, right? So that is why I think that for Mapletree Logistic Trust, it really makes sense to be present in many countries. And looking at occupancy is close to 100% regardless of which country we are looking at. And that's probably due to a combination of factors, because logistics now is very hot due to the demand from e-commerce. The other thing that we can also say is that the management is probably very competent, right? Able to enhance the value, probably find good location properties such that the demand is high. And the tenant management is good such that they are able to retain them. In terms of total return, 10 years is over 100%, 165%, and average return of about 10% per year. So it's still considered a solid track record over here. And dividend growth has also been very consistent, right? Year by year, there is increase in the distribution per unit. So you get more dividends as the time goes by. So dividend yield is about 5.5%, somewhere in between Mapletree Industrial Trust and Keppel DC REIT. So in terms of valuation, Mapletree Logistic Trust is also undervalued in the sense that it is trading at the below that -1 standard deviation, right? It is near the COVID low, okay? So which means you still get a chance if you didn't get to buy in 2020, you didn't get to buy at the low in 2022. Now it is still not too late, in my opinion. So all in all, you can see that these three REITs are trading near their 5-year lows, and coupled with that, the interest rate risk is lowered. The rate hikes are not going to be very significant going forward. It might signal the bottom for the REITs. The worst might be over. But it's important to remember that not all REITs are equal. I won't go for those high yield REITs. I do think that they are priced for certain risk. And some of these quality REITs that we have seen so far, their yield is about 5 to 6%. It is not very high, especially if you want to compare to the risk-free rate, which is now 3+%. But I do think that they are generally good investments, good long-term investments, because they do have the propensity to grow their distribution per unit and grow their property portfolio. They're well managed, and that's what I think investors will find more comfort in holding them over a longer period. And of course, we don't know whether this is the low, right? For all we know, maybe there's some other things that happen, but always be prepared, right? If the prices go down and the deal remains good, the fundamentals remain strong, there's a good reason why investors should do dollar cost averaging, right? Buying more when the prices are lower, that will lower your average entry price as well. And when the prices rebound, it's also easier for you to make profit out of it. So hopefully this video has been useful, and the REITs idea, you can definitely take a deeper look at them. Hope you like this video. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.